G'day, listeners, and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, I am excited for another Common Investor Mistakes episode. You guys have been writing in saying you love these things, you want to hear more of them, so I've got the crew back together. I've got big Mr. Paulie Karpierz, a.k.a. Mr. August. Mate, welcome back to the show.
Sammy, thank you. Have you found my calendar yet?
I have found the calendar, mate.
He's got it up on his wall. It's on his wall.
It's on the wall. Yeah, it's in the office, bro.
In the office?
I'll show you after. Yeah, it's in the office.
Okay. Yeah, keeping that to yourself, weren't you, Sammy?
Mate.
That's how he likes it.
Looking good, bud. Looking good. When was that? How long ago was that?
Thank you. We're talking maybe first year, back in, 2018 it would have been?
Yeah.
A few clients have asked. They go, where do we find Mr. August in the calendar? I go, mate, I can't tell you. He'll kill me.
I think for some people have actually asked, the next summit, are you going to do a show?
Yeah.
Like with the fire
pole show.
Oh, you want the turnouts out and everything. Do you want a puppy with that as well?
Here we go.
Oh,
Jesus.
wow. All right.
Jimmy's
maybe a kitten.
Jimmy's more of a kitten kind of guy.
Can I finish my intro?
Okay,
Sorry,
sorry.
mate. Next on the agenda, we have the giant Mr. Teeuwsen, mate. Welcome back to the show, Mr. Property Economist himself.
Thanks for having me. Back in black. Here we go.
You're actually in like tan or sand or whatever you call that, but
I'm trying to get people to go to YouTube to watch it.
okay.
Ooh.
Well done. Well done.
Nice.
Well, Jimmy and I actually are back in black. And speaking of Jimmy, aka the Silver Dog, aka Gandalf, mate, welcome back to the show. How are you?
Very well, Sammy.
Good to see you alive and well.
It is great. I do love these sessions with the boys and everyone getting together. So thanks for having me back.
No worries, man. How
Still
you
got my
enjoying?
seat.
Yeah, back up on the old Sunshine State, mate. How you feeling?
It is great.
We've
It
kind of
is.
kept the same flow going of the table and the seating and everything. I thought we were maybe going to mix it around, but mate, we've kept it the same.
Mate, if you're on a good thing, why change?
You're going a bit. It's been cold in Melbourne, because you're a bit pale at the moment.
I am a little. I'm losing my tan. I had a little tan, but
fake
it's
tan.
gone. It is gone.
A fake tan.
Got to put the fake tan on.
All right, tan, bro. Speaking of Jimmy and his tan, mate, I want to start with you.
Ooh, wow.
We're used to a weak finish. The listeners said, let's start with the shit and then finish with the strong. So, mate,
wow.
speaking of,
Wasn't expecting that, Sammy. Wasn't expecting
was
that.
keeping you on
but
your toes. All right, Mr. Hare.
Let's
go, mate.
I've
Let's
really
jump
enjoyed
into
this.
it.
All right,
Let's
let's
jump
get into
into
it. So the first key point I would like to bring up is, as you build out your portfolio, and I think we're talking about 10 plus portfolio, and that's
Advanced, yes.
Yes. So you might start thinking about upgrading your portfolio management and how you look after your properties and your documentation and the numbers. So me personally, because I use a Xero for my business.
Okay.
And my bookkeeper now looks after a lot of my property stuff.
Okay.
And I have, with my trusts, they're all in Xero.
Okay.
So that it's a lot easier for my accountant to look at reports and so forth. And
Okay.
it's just logging everything in there. So it's just a way to streamline in preempting when you add a whole bunch more. So for me, what I'm trying to get people to realize is that as your portfolio grows, start thinking of ways to maximize your time, your efficiency, to get the more out of your data. Right? More out of your data, you make better
So
decisions.
now that we've tooted the Jimmy trumpet, what's
That's
the
not about
mistake?
me.
What's the mistake?
Well, not doing that. So if you don't do that, then all of a sudden you start adding more and more properties into your portfolio and you're getting more frazzled because you don't know Arthur from Martha. And then all of your documentation gets scattered. You're making poor decisions. You're not getting your finance done. You're not getting the stuff to your accountant. So that is a massive issue. People don't underestimate that.
And as the portfolio starts to get a lot bigger and better, like it can take, it's a lot of time to kind of pull docs together. I remember when I used to get to, when a portfolio got to 20, 30, 40 properties, all the rest of it, it'd take me like a few weekends, to pull it together. So, it's a great point to make.
Thank you very much. Don't hear that very often from you.
I was talking to Lukey.
Point number 2 is potentially upgrading the advice you're getting. So your broker or your accountant may have been able to get you to a certain point, but are they going to be in your corner to get you to the next level? So don't be afraid to start asking those questions, having those conversations, and potentially looking at other people that may help you get to that next level. That's a really important point.
I think that could be almost more of a temp check, right? So a bit of a temp check on where you are, because if someone is able to get you to 10 property portfolio, speaking of brokers, accountants, buyers agents, all that sort of thing, essentially your team, if they can get you to the 10 property portfolio, they're probably reasonably well versed. I think it's good to take a temp check on it. Is there someone that's a weak link link in your journey that maybe you could sub out, a little bit like what we're considering doing with yourself and others. But the weak link
And others. I'm worried about and others.
He's got his eyes on you, Lukey.
There's a reason you boys are on that side of the table and Paulie and I are over here. But honestly, yeah, having a good look at like, is there a weak link in the team that you've got at the moment? Is there someone you could potentially trade out? And that could even go for property managers, accountant. It could literally, it's across the board. And I think it's one of those things you need to take a very good close look at. Ultimately, no one has my business for life, right? And they have to continually perform because ultimately, you have to look at your property portfolio as a business. So if someone starts dropping the ball, maybe they start getting too big or they start getting too cocky and all the rest of the stuff. Sometimes you have to move on from those people so that you're still getting that sort of A-grade, top-notch service. So
same applies for your property managers too.
100%.
You know, if they're dropping the ball and they're not doing the same thing.
Same happens with buyers agents. So we have so many clients. You boys, obviously, all three of us, all four of us, sorry.
Is that an internal joke?
No, it's
that an internal
joke. Three of us boys and
internal
female dog.
Internal joke. Canned laughter begin.
But all four of us, we're essentially enough on the front line that we speak to a lot of clients when they come through. And quite often, someone might have started with a buyer's agent who was maybe okay, or maybe they were good, and then they got too big and they weren't able to properly service them anymore. Maybe they didn't care so much about them anymore. And I think it's one of the cool things about us, even though, yes, obviously we are growing, we are getting bigger, we're building it so that we still service people at a really high level. We're just able to help a few more people from that perspective as well. But I think a temp check, is seriously important across the portfolio for everyone. I regularly temp check my property managers. And if there's any issues, if people are dropping the ball, if I'm dissatisfied, especially if I move out of an area and I have no longer have a relationship that I need to, retain from a getting deals perspective for our clients and whatnot, if I no longer need to retain that and they're dropping the ball consistently, we're actually talking about one of the property managers the other day, Paulie, last night. And if they're dropping the ball, then, once you move out, that's the time to essentially, I will typically consolidate. And again, an advanced investor tip or mistake is sometimes they don't do that and even consolidate multiple properties into the one property manager that might be a bit of a higher level.
Good point. Next one is not maximizing your opportunities and your strategy within super. So a lot of people that generally build out a 10 property portfolio, most people are buying outside of their super, and because people just don't really understand super, and this is not financial advice, but there are opportunities that you can be putting and maximizing that position. So getting both angles, in and out, working towards that end game.
It's a great point, Jimmy. As he has mentioned there, obviously none of this is financial advice whatsoever on this podcast, but superannuation, SMSF, is definitely an overlooked vehicle from a property perspective that isn't really considered that much or enough these days, in my opinion, to moving forward.
I've got just a couple of quick ones still, because the next one I think is quite good.
Should we put the music on?
Well, no, because I think
come on, Jimmy,
understanding where your portfolio is at, because at this stage people will be tempted to go into the primary place of residence. So just being very aware.
So would you say sticking to your strategy?
Sticking to your strategy. Don't buying the PPOR too soon. Too early.
Wrap up the portfolio.
If you just held off maybe a few more years and made a bulletproof plan for your portfolio and then get your PPOR, you're actually going to get the ultimate goal. So just not jumping the gun on that.
I feel like so many of these points are super relevant to both intermediate and advanced investors. So I think everyone out there listening,
even
100%.
beginners, intermediate, they're all relevant,
of
right?
course.
Last thing, and it wouldn't be my segment if I didn't bring up the
mindset. We're going to talk about some mindset now.
So monotone. I love it.
Yeah, that sounds great. It is about being mindful of your ego. Now, what I mean by this point is when you're at that 10 plus portfolio, ask yourself, am I buying 20, 30, 40 properties because I need them, or am I buying them because I want to tell people I have a 20, 30, 40 property portfolio? And this is really important. So that temp check of knowing what it is that you want. Otherwise, you're doing it for the wrong reasons. And if it means that you're just trying to get a bigger portfolio because your ego says so, but you're neglecting spending time with your kids, or you could tap out, you could exit, and you could spend time with your kids. You could spend time with your family. You could do whatever you want, that passion project. That is where life really is. So keep your ego in check and ask yourself, pressure test yourself constantly if you are on the right journey or not.
Any comments from you boys?
No, I think that's good,
No.
Jimmy.
I think it's a great point, man, because like a lot of people, they get hung up with like trying to go too far with it and trying to like, you know what I mean, push it to some crazy level. And I think like realistically, you need to figure out what it is, like obviously stay on the path of what it is you're chasing, execute to that level. And then exactly in your scenario, if there's other things there in life you want to go out and enjoy. Now, if it's an ego side of things, it just makes you want to get it bigger and bigger. It's just one of those things. It's not going to give you the fulfillment that you're actually chasing. If you are chasing a massive goal and that takes 20, 30, 50 properties, whatever it is, that's a different story. But realistically, if your goal is achievable, which most people's are with a 15, 20 property portfolio, be very strategic in obviously getting there, and then obviously enjoy the fruits of the labor after that. Don't get too hung up on, as you say, chasing the continual happiness.
I've had a client before in a strategy session. They're like, man, I'd love to have a portfolio the size of Sammy's, but I don't need it. He goes, man, this is what I want to do. I want to get to this, and I want to go and, take some holidays. This is what I need to live comfortably forever. Man, that portfolio would be mad, but I don't need it. I've had people say that to me before, and
100%.
I'm like, that's such a good way of thinking. They know what they want to live, and that's their comfortable lifestyle. Once they get that, they're going to enjoy it. They're going to enjoy, the fruits. And
the other side of things as well, people don't understand the amount of work that comes with a portfolio that size as well. Like once you start going over like 20, especially once you start going over 30, like it's almost, it's not a full-time job, but there's a lot involved with it, managing it, keeping on top of it, and obviously even from a tax perspective as well, it's a massive ordeal. Talking about 50 plus property, it's wild. It's essentially it's another job, managing that side of things. So it's one of those things, man, putting things in check, even like that, with the ego side of things, like knowing what you're building something out for and then building towards that. Not going crazy with it because all of a sudden you change your goals from 300 to 500, but did you need the extra 200 grand? If you've got a primary residence paid out, do you need more than $300,000 a year with a paid out primary residence? Probably not.
And the great part about it is the strategy, whether you're buying 5 properties or 50, it's the same.
Yep, 100%.
That's just the scale. So that's it from me, Sammy boy.
Jimmy,
thank you very much. My work is done. I'm gonna leave.
Yeah, go get the Uber, mate. See you later.
See you later, everyone.
Paulie K, the man, the myth, the August edition legend. Mate, hit us with your points.
Yes, well, I'm thinking if you've got 10 plus properties and you're an advanced investor, there comes a time where we've got to consider selling off some of these properties. And that all sort of ties it around that exit strategy piece. And really understanding what your exit strategy is. And if you don't have that exit strategy, that can be a very crucial mistake at a point in time. Are you selling properties in incorrect market cycles? Are you not selling properties due to like CGT? So understanding market cycles, I think that's very important.
So not selling off because of CGT, like being worried about paying some capital gains.
Yeah. Knowing when to sell, when not to sell throughout the process of that exit strategy. And knowing, having that clarity with your strategy. So I feel
like it's such a small-minded thing to not want to sell and pay some capital gains tax. Mate.
Isn't it funny? Never sell. Never.
I know. But even the idea, though, around like the capital gains side of things, right? And my biggest issue with it is your standard residential investments, you're essentially what I call single keys. They don't net like yield high enough to warrant holding them forever. So we always like it's either it's multi-income streams or different avenues or whatever that we're going to get higher rental returns from. But when it comes to this stuff, they're in the portfolio for a reason. Right, they are a business vehicle. They are. I look at them as like an employee in the business. Once they've done their job, see you later. It's time to go. And essentially it's like making someone redundant. But you've made great money off them. They've done their thing on their way through, and then you're selling them. You're selling it off, and then moving forward. It's part of business. It's part of the business of a portfolio. So, man, I love that. That's a really, really crucial point. That so many people, they kind of go through and they might build out a big portfolio, but they don't correctly build in the exit strategy or understand what their exit strategy is, and then 20 years on, they're still working because they didn't acquire the right deals or sell off the right deals.
Yeah, I mean, so that was basically my 3 points, all sort of tied in as one big one.
You went very quickly through them, man.
It was very sharp.
Yeah, just to the point, to be honest.
He's efficient. The firefighters, they are very, very efficient. They do not.
I think as a last point, I guess as a sort of add-on on top of that would be sort of keeping updated with the market. So, keeping abreast of what's going on. I mean, you're in this game now probably for 6 years plus now. So keeping on top of that's quite important as you're sort of holding the properties as well throughout.
Yeah. And that kind of ties in a lot with your exit strategy, right? Because if your exit strategy and if you're an intelligent investor and you're going down the sell down process as things come through as well, you want to understand what's the market doing, what is that market doing in that area that you're invested in to make sure you're peaking out at the right times, keeping your finger on the pulse, not missing those correct moments when the time is to sell. I look at, sorry, Lukey, I know you're just about to start something here, but I look at the time when I sold Wollongong and I fluked the time timing of Wollongong. Like I'm the first to admit, I didn't intentionally correctly time the sale of Wollongong when I sold it in July 2017. It was only 6 to 12 months later that it came out. The peak of the Sydney cycle was in July 2017, literally when I just happened to get a contract on that deal and sold it because I needed to sell it. But I look at it, which 50 grand to me was a huge amount of money. And within 6 months, it had gone down 50 grand after the peak. Because once the heat goes out of a market peaks out, right? And troughs off. And that extra 50 grand to me was a deal, probably almost 2 deals back then. So that was a huge tipping point for me of timing the exit out of that market as that was obviously a fluke, but that's something that that experience taught me so much to make me want to understand how to pick markets peaking out as well. So man, I love that. It's a great point. Obviously keeping your finger on the pulse of everywhere you're investing.
Mm-hmm. Yeah, thank you.
It's not as if you have a small chunk of money. When you got 10 properties there, you're looking at... There's very few properties that are good under 300K anymore. Yeah. So if you're looking at, let's call it 3 to 500K, you're looking at $3 to $5 million minimum on a 10 property portfolio. You're not talking about a small sum of money. So if you're not keeping an eye on the market, think about anyone that's got 3 to 5 million. They want to know exactly what that's doing.
Cool.
What's the market doing where that money is?
Well, the other thing as well is you think about that one that I sold was a 10% variance between what it peaked at and then probably what it came down to. It would have come down to 460, 470. So it's 10% plus. You think about a 10% variance on a $3 to $5 million portfolio. We're talking 3 to 500 grand. But if that portfolio has gone through a cycle, maybe we're talking a $6 to $8 million portfolio. We're talking $6 to $800,000 mistake you might make if you miss the peak or you hang on too long or decide to sell and then maybe I will sell. And it's a year later and the market's come right back down. It could be more. So, mate, that's a very, very solid point, especially when people are going through that exit strategy, they're going through the consolidation. You need to be very, very diligent with this. And we actually work closely with clients on this when it comes to the exit within Australian Property Scout as well.
I think with that as well, like a lot of people got to put it in perspective. Like if you're managing $5 million for your boss at work and you didn't manage that to the best of your ability, there's going to be some issues there. You've got to take that same approach to your own assets and your own portfolio that you would at work. There's lots of people out there that do handle large amounts of money for their workplace, but then they're terrible with money at home. Why is that not replicated? If you're great with money in your workplace, why are you not doing that at home?
Yeah.
You need to. I think that's a great point, Paulie. Looking at what you've got and managing it should be a big priority for you.
It is definitely the best point so far. Yeah, it was fantastic.
Sorry, Jimmy.
It wasn't hard.
Don't apologise.
It wasn't hard.
Apologise to win.
No,
what are you talking about?
We don't apologise to Jimmy.
We don't apologise for winning.
They haven't had their chance yet.
So I get my trophy then.
Not
Is that what you're saying? I get my trophy.
You get your trophy, mate. You get your trophy. You know what's coming up soon? It's the inflation numbers. We'll see if Lukey gets his Chivas Regal or not.
I'm getting it.
You reckon you're getting it?
I've had a few people ask me about it. I'm like, I very rarely drink, but if I do, that's what I'm having. And they're like, Sammy's buying you one, isn't he? I'm like, yeah, absolutely.
Every time I've seen you, we have a drink.
Well, that's only when I'm with you.
So Jimmy brings out the worst in you, essentially.
Absolutely.
Circle of influence.
Circle of
influence. He brings Melbourne culture up to Queensland with him.
Anyway, Lukey, what did you have for your section?
Lukey.
I think the biggest thing for me is someone that has more than 10 properties. You've been in the property game a while. You don't just wake up with 10 properties. You've done properties over a number of years at that point. So the biggest thing I see is people comparing previous deals to deals they're doing today.
Yeah.
That deal I got, oh man, that deal was a stonker. I got, X amount off the price on the way in and it rented for this in comparison to what I purchased it for. Those deals are from 3 years ago. If you go and compare them to your current deals, you may miss some really good opportunities if you go and do that. I see it. We see a fair bit. Don't compare the market of 3 years ago, 2 years ago, 1 year ago, 6 months ago to deals you're doing today, or you will miss some good opportunities.
You wouldn't do that for 10 years ago, would you? Like you wouldn't. You just don't make that comparison. But because everyone's had such a good run, they do that.
What I love to look at though, it's like the rental and the price growth that we have during. Like that's why you're getting into the market. Okay, well, like that's what those deals did. 3 years ago. You should have bought more 3 years ago. We told you to buy more 3 years ago, right? you didn't, or that was a level that you could buy at the time. This is the opportunities now. We're going to different markets at different points, but these are the opposite we can obviously pick up in the portfolio now. But what I love to look at, probably the biggest thing that I always love to look at, like I look at some of the unit block deals that I did 3, 4, 5 years ago, and I bought them at 9, 10, 11% yields, something around that, and I renovated a few of them to give them a little bit of a boost to go a bit bigger. Now they're all sitting at like 20% plus yields.
Wow.
In like a 3-4 year window. I look at a lot of the grannies that I did around 8.5%. You and I both. We did deals 8.5%. With the rental growth that's come through on a lot of those things, not even taking into account price growth, but just the rental growth. Most of these things have moved to like 14, 15% plus yields. They've had 50% plus rental growth in that time frame. And it's just massive, to see that sort of come through. And man, that's what I love the game for in the long term when it comes to property. And we're talking only 2, 3, 4 years. When you start talking like 10 years, and I look at 10 years back at 10 years of the stuff that I bought in Sydney, most of the stuff's quadrupled. It doubled, and then it's doubled again during that. And that's like an abnormal cycle. But at the same time, right now we're also in an abnormal cycle in other markets. Just because Sydney did it during that time frame, now we're in that cycle, that same tipping point in other markets. So it's all part of getting into it. Man, I actually don't find I have that much pushback from people, especially who were with us from a while ago, because they understand our ability to pick markets. You can pick a market in the last 3 years that's done 10 to 15% a year, right? It's not hard to throw, to pick a market that had done 10% annually over that time frame. What's hard to pick, and you look at Paulie's portfolio, is markets that have done 90% plus, in a sub 3 year window. That's not easy. 30% plus a year. And that's where I think, like, man, most of our people, they sort of understand, make 5% or so on the way in, and then being in the correct market that will do majority of the heavy lifting, that'll take care of the rest of the portfolio. And the cash flows is the same thing. Interest rates are at a peak. They're going to be coming back at some point in the not too distant future. And then obviously rental growth coming through as well. Your rental growth, price growth, it's all like a cumulative snowball effect. If you fixate on what things are at right now, that's a mistake that's obviously going to haunt you, I reckon.
Yeah, I agree. I'd say 99.9% of our clients are great at it, and they know that if we present a deal to them, it's going to be a great deal. They're going to get a good discount. It's going to perform well. I'm also talking about those few people that, mindset, they're like, oh, but is it as good as that one I did 6 months ago?
The wins were so big that it's like hard to justify almost.
That's it. So I think the second one is skipping the little things. When you got over 10, those little things can add up pretty significantly. Things like depreciation reports, get depreciation reports, making sure you're getting good tax advice and you're, documenting everything you do, everything you spend on the property, etc. The odd $50 here, there, and the other way on a course of a property portfolio that big. The course of the year adds up, so you definitely should be getting that through to your accountant. But those little things like speaking to your broker and making sure your loans are, set up right, making sure you've got offsets for, those cash buffers we talked about before. Instead of just sitting that in an account doing nothing, that should be sitting in an offset account, offsetting your interest. Your return on investment is your interest rate. So if you got 7%, you're getting 7%, but you're saving it. So those little things add up on a portfolio that size. So across, although they may seem small, they definitely can add up on a portfolio that size for
definitely.
sure.
Man, I'm so guilty of
I was going to bring up that point.
Depreciation reports.
No, but do you remember that example you said about the property management report and there was missing some rent or something? I'm trying to remember. We spoke about it one time that you didn't realize you weren't getting the rent into your property or something. Do you remember?
Well, nah.
One of your
You went through the reports and you found out that there
you
was
weren't
like
getting
a
the
50
granny. You weren't getting the granny rent or something because it was yielding so well.
It was being held or something. You know what I mean? I was sitting in a trust account or something. Is that what you mean?
Yeah, and you hadn't because you
I think it was like 3 months.
Oh,
You didn't
it was
find it
3
for like
months
3
of a
months.
granny rent, and
they
it
owed you.
It had
She
been
had-
sitting in the trust account.
Yeah.
Yeah, because they can't pay it out. It's obviously like massive deal if you pay incorrectly out of a trust account. Sorry, I do remember it now, and it was because I was looking at the whatever it was like 9, and I wasn't looking at the 9A statement for the
That's
second
right.
for the second
That's
one,
right.
and it wasn't coming through. They actually didn't have it, and that's when I picked up and going, hang on a second, where's the rental thing? But I hadn't done an audit on my portfolio in like 6 months, and that's the thing, man. Sometimes things can get away, and Yeah, I was having a laugh like a second ago when you were talking about it. You're talking about depreciation reports, and I've just submitted about 20 reports to go in because I just outdate. I buy about 10 properties a year, right? Plus I build extra things on top, so it can get out of hand quickly for someone on the size of the portfolio I have now. But yeah, man, it's one of those things. Like it's money being left on the table, especially for cash flow deals. You got grannies with really good depreciation, and you're going to hold those things forever. So it's one of the things you want to make sure you get in, especially in the high interest rate environment. Even when you're offsetting additional profits, obviously the portfolio is quite positive. You want to make sure you're offsetting as much as you can, whether you're offsetting to write tax off and get some back, or write off so you're not having to pay tax on it as well. So it's a really, really good point, man. I love it. It's very, very important thing. I think it's somewhere in here with one of mine as well.
Last point, you got another
I
one?
stole your point. No, I'll take it. So my main thing for the last one, Jimmy, it's a mindset one.
Oh, the mindset.
My name's Yuki. I like mindset.
It's the mindset.
You watch Mindhunters? Mindhunters is a good movie. Good TV show. I'm trying to give you a bit of respite, Lukey, so you can start. Let's go.
Is this the mindset bit?
Yes, it is.
Is this the meditation part? Just be quiet.
No, just zen, mate. Forgetting where you started. So as people get the results and hit their targets, their expectations and their goals change, and there's nothing wrong with that. You go hit your goals and you go and set new goals, and you go and up the ante and keep progressing. But I feel like people forget where they start. A lot of people, when you start, you thought, man, getting 2 properties would be amazing. Then getting 5 would be amazing. Man, I got 7 now. Hit 10. You're an advanced investor, and now if you're at 10, so many people lose sight of where they started, and they, don't value where they are today. I think I don't know if I've mentioned to any of you before, but heard something really cool, a while ago, and it was, you've already done things and you've already hit goals that you said would make you happy.
I know where you heard that. You heard that on Hormozy. He did the podcast with Chris Willax just recently. That's an epic podcast for anyone who wants to listen to a banger.
Yeah.
I actually sent that to my sister.
That was only recently. Hey?
Yeah, it was a couple of weeks ago. Yeah.
So this is only very new. But when I heard that, I thought to myself, that is crazy. You've done things you said would make you happy.
Yeah.
Why aren't you happy? So I feel like that's a crazy way of thinking. And I feel like for advanced investors, that's a mistake. You you should be valuing where you're at. You should be looking back and going, man, I've come so far.
Yeah.
It's not about being ahead of everyone else, but I've hit what I've wanted to. I've done such a good job, just making sure you remember where you came from.
Yeah.
One of my mentors always talks about the gratitude piece and trading your expectations for appreciation and showing gratitude. And if you believe in whatever you believe in, but he always says, the universe will reward, will only reward you for things that you're actually grateful for. Like, why would someone give you something that you actually don't appreciate? If you believe in that or not, it's irrelevant. But the gratitude piece, at least it's going to make you feel good because you actually take stock of what you've actually done and try. And I'm not great at giving gratitude to myself because we're pretty hard on ourselves. But I think it has to be like anything, like your training and all that. It needs to be something you need to apply yourself at and take time to show gratitude for what you've got, even if it's to talk to yourself and say, you know what, you're doing well. Like, give yourself a pat on the back, at least.
Yeah, man, it's a great point. Like, cause I never think about what I've done. I literally never think about it. It's a really hard thing. It's like you were talking, literally that exact quote. Read the quote out again.
You have already done things and you've already hit goals that you said would make you happy.
Yeah,
that's a cracker.
Man, it's crazy, bro. Because like I'll go driving in the Ferrari and Morgs is like, "Does this feel real? Like, how do you feel?" And I go, "Yeah, it feels good. Like, yeah, it's mad. Like, I love it." And then she's like, "Does it feel real?" And I'm like, "Yeah." Like, it's weird, man. I think because like, and this is the thing of leveling up as an investor, and people will know this who have already kind of gotten to this point, especially if you went through a serious graft to get there. When you've genuinely earned something that you finally get, it's a really weird feeling because you've kind of leveled your way up to get. It's not like you were just given a Ferrari or you were just given a primary residence worth X amount or whatever. All these sorts of things. You had to, if you genuinely had to earn it, it's a funny feeling when you kind of get there because you do feel deserving of it. But it's a weird thing because you try and reflect on it and you try and look back on it or whatever. And it's such a hard thing to do because when you look at it, you're like, we have fucking worked my ass off for 15 years building this portfolio so I could buy that, but it's a hard thing to then reflect on and go, you've done so well. You know what I mean? To kind of get to this thing. And anyone that's gotten to a 10 property portfolio that we might be speaking to right now, you literally have done so well to get to a 10 property portfolio, because it's 0.01% of Australian property investors have 6 or more properties. So imagine how small that number is. Probably add an extra 0 or 2 in there before the 1. That's probably how many have 10 plus. So you've done exceptionally well. But I can relate to it because it's such a weird thing, because you've worked so hard to get to that point. It's just, it's a weird thing, man, reflecting on it. That's why I can fully relate to what you're saying there. Can I
ask you, right? Because it's one of those things that the Ferrari is great, right? And
because the Ferrari to me is the milestone. It's a thing I've chased since I was 5 years old.
I get
when
it.
I first saw one.
But what I'm thinking is the juice and the real satisfaction is going through all that shit things. And we were talking about this last night. That challenge and that obstacles, that's the stuff that makes you feel good. Like the car is the reward at the end. But because you went through the mud and you did all the crap, that's the stuff that I'm asking you, when you reflect back, that's the most proudest thing. It's not driving a Ferrari around the street. It's in the trenches. Yeah. And people are so quick to get out of that thinking that when they get the shiny thing, that's going to make you happy. But it's not that. Yeah. It's who you become along the way. And it sounds really, philosophical, or it's a bit of a fugazi, but it's actually true, because it's in the trenches that you will, there was a study about people who, she was interviewing people who passed away or close to passing away, all, very elderly, and what was the most proudest thing that in their life. And they often looked back at the things that defined them or the challenges they overcame. That was the most proudest moment. It wasn't the big house or the cars. So when we're all in the trenches doing this, it's important reminder to take stock that you're actually living the best part.
Yeah. Yeah, 100%.
It blows my mind.
That's one of the...
You're doing the things that you said would make you happy.
Right.
Yeah.
It's like, it's a day-to-day thing. Like, it's the same thing. Like, I've always wanted to be a dad, and I like you see the kids and you see them grow up, and it makes you sad watching them grow up. But you're living the life that you've always wanted. That's the crazy part. And what I wanted to say with Sammy before is, so many people see the end. No one was there when he had to grab his balls and go, I'm going to go have a swing in Brisbane here. I'm going to buy 10 at the highest interest rate. Everyone's like, interest rates are going to 0. And Sammy's like, mine's at 5. Oh, I'm still going to go. No one was there telling him to do that. No one's there having a crack with him. That's when people forget all of those trenches moments where no one was there. No one was there doing that.
The old Marine saying that everyone wants to go to heaven, but no one wants to die to get there. So everyone wants a $30 million portfolio, but no one wants $15 million worth of debt.
or the absolute battle to get there as well.
So
you know what's funny though? We're just talking about this, and you guys had a few things popping in my head. You're talking about the trenches, and I think about like the things that I miss the most are going out and renovating my own properties, speaking to the random dude that walks in from the street and wants to have a chat with you, and then going to Bunnings and going to buying all your stuff, and then going in and smashing this thing out,
trying to swim in a lake in Mount Gambier.
Oh, mate. Doing 18, 20-hour days renovating houses, you know what I mean? Like, that's the stuff. Like, you're absolutely cooked when you finish it, but like, I miss that. You know what I mean? I miss it because when you finish that, you're like, that's fucking pretty good. I bought this piece of shit with shit on the walls, like with Paulie here. But I've gone in there. Maybe I'll get that bond cleaned first, and then I'll do the rest. But you get stuck in, and then you turn this thing around, and like they're the things I look back on, and it's funny because like what I've built, the proudest things are almost those things I got my hands on. That's why like I look at APS and like even you boys being in the team with us, and obviously working very closely with you guys as well, and looking at everyone else within the business too. I have so much pride in what we've done in the business and what we've built there, but what we're building in other people's portfolios as well, And I think like that is probably almost the biggest thing I get excited about, and that I get massive. I think when I look at it and get the gratitude side of things, like I feel it when I look at that side of things, because the property is a funny thing. Like you build it to a certain point, and it's like you feel accomplished, but like not satisfied, if that makes sense. You know what I mean? The satisfaction comes from getting the life, like the freedom to be able to do what you want. That's amazing. But it's it's don't get lost and miss the journey on the way through, because sometimes that can actually be the most satisfying piece of the whole
100%.
thing. I don't know if you guys can hear, listeners. We got a fucking storm raging down right now. I don't know if anyone else can hear, but we're just looking at each other going, what the hell? Yeah,
It's coming down.
I don't know. Yeah, I don't know if we'll pick it up that well.
Are we in Melbourne? Or are we
Boys,
in...
that is I think this dog brought his weather with him. Maybe a flight will be a little bit delayed. I'm going to jump straight in and bang out my final things. We've got 6 minutes to complete 6 things here. The good thing is we covered off on a few of them. Big Paulie K here. He's all over some of this stuff as well. And Big Lukey. None of the points, funnily enough, as advanced as they are, were on Jimmy's sheet. But anyway, moving on, guys. I think one of the biggest things really that I think a lot of people kind of come unstuck with and don't manage properly is their cash flows. So managing cash flows of a larger size portfolio, all the things that Lukey was talking about before, being on top of even property managers pushing rents to the top. I'm always very diligent with where rents are sitting. I don't normally, if I've got a good tenant, I'm not trying to push them to the max, but I'm keeping them within touching distance because so often I pick up a bargain because someone never kept their rents in touching distance and then people don't see the value because of how under rented a property is. So I always make sure it's very strong on that front. I try and keep on top of all the things as we go through as well. It's one of the big things. Manage your cash flows, manage your little nitty gritty things. Even if you're just doing it just once a month to stay on top of everything, it's very, very important. Paulie K, stay with the next one. So I'll move on to number 3. Trying to hold everything forever. Fuck, he almost stole this one as well, I think. But essentially like the exit strategy and not trying to hold on to everything in your portfolio as well. I think it's one of the biggest mistakes I see and why a lot of people for their journeys would turn into a 20, 30-year journey, 15, 20, 30-year journey when maybe they could have done it in a 7 to 10-year window because they are fixated on holding things forever. There's other experts, experts in inverted commas and people out there saying, oh, buy, never sell, all the rest of bullshit. You never sell a good asset. They've never retired from property. I guarantee you that. They've never done what you want to do in property because to do what you're trying to do in property, you need to retire debt. And you're trying to do it in a decent time frame. You need to retire debt in a decent time frame. Anyone that tells you that's wrong, ask them to show you their portfolio before they became whatever they're doing now. Guarantee you they didn't do it. Larger goal investors, one of the biggest things I see as well with a lot of those guys that I deal with too is they get complacent and they rest on their laurels. They don't bring their portfolio to completion. Jimmy here is a prime example. I'm just literally calling you out because you're sitting across from me. You want to build a $500,000 portfolio, but you take a year off from acquisition because you get too busy in life and too many things are going on and, you beat your own chest. You don't beat your own chest, but like you're happy that you've hit the 10 and then you sat and you rested on your laurels and you didn't keep moving. You just missed a great year of growth last year in the portfolio.
100%.
And so like when I look at it and I see so many people that do the same thing, they get to a really good milestone that most people would be like the portfolio they need for maybe a 150K income goal, like Big Paulie K is chasing, and maybe they stop at the 10. When in reality, if they're chasing 500, maybe they need to build, depending on the strategy, depending on where they're coming from, what they're starting with, the properties that they're acquiring. Maybe they need a 20, 25 property portfolio or beyond, but they stop because maybe they hit double digits. They get complacent, right? So one of the biggest things is continually assessing what are you doing, what are you chasing. If you're needing 20 to 25 properties, you don't need a year off. You need to keep acquiring as hard as you can in those early years, keep building that consistent accumulation so that snowball effect can start to take off in your portfolio and you can reap the rewards in the next 5, 7, 10 years. Other big thing, holy shit, Paulie Karpierz is freaking on, mate. Jesus Christ, you reading my mind.
Just take a few more.
You're reading my mind, mate. You can see who's the number 2 on the most educated on this table.
It's not you, Jimmy.
No, I don't think so.
Just to clarify.
I didn't
Not
think so.
keeping your eyes on the market or your finger on the pulse. So once again, going back to even rentals in an area and what you're doing out there and obviously keeping your rentals in touching distance. Most people are trying to build a passive income portfolio. 99% of investors, that is what they're chasing. Why would you let your rents fall well below market value? Why would you stay with a property manager that is not willing to keep rents at market value or close to market value with a good tenant? These are the things you have to be cutthroat about. You want to take your portfolio to the top level, you need to be cutthroat and stay on top of these things. And that is not only obviously the rental side, but it's also the exit side. So when you have bread and butters, those markets are peaking out. It's having your finger on the pulse or working with someone that has their finger on the pulse to help time the exit. One caveat on this is that does not mean a real estate agent, because a real estate agent will try and con you, sell you into selling your property. They don't really care about a vested interest about whether it goes up another 100,000 in the next 12 months, because they'll probably sell it again in 12 months from the other person you sell it to. So very, very important to have an unbiased opinion that is helping you with your game plan on exiting a market. this is super, super key and super important to actually reaching your goals for a larger income portfolio, pretty much for any income portfolio when you're exiting. But this is the biggest thing I see. A lot of people, they take their finger off the pulse because they've got so much going on. They're not staying super dialed in on the markets that they're investing in. And my last point, guys, which is probably just a little side note, is not factoring land tax into their equation. So something I've seen, not typically with investors that are with APS, but outside investors outside of that as well, they might have had great success in one area. Maybe they're a builder in a specific area, or they do renovation projects in a specific area. Maybe they've made good money in a rising market, but then they keep trying to invest in that same market, or they keep hanging on to property in that market. If you're in a market, say like Sydney or Melbourne or something like that, where land tax is excessively high and there's no real ways, structure-wise to mitigate that side of things, it can be an extremely expensive process to not understand how to mitigate it and be as clean as possible, as diversified as possible with your portfolio in this space. So it's one of those things, if you're planning on building a big portfolio, maybe you're an investor with a very large portfolio already in existing location. If that location is peaking out or is peaked out, is it a potential, maybe have a chat with the financial advisor, have a chat with the accountant. Is it a right time to maybe offload a couple of things and then reinvest those funds and those profits and that debt somewhere else to make a bigger gain elsewhere?
Well done, Sammy. I don't think we could have said it better ourselves.
You definitely couldn't.
Unless...
Paulie Kane might have been able to.
Well...
Mate, he had a lot of those.
If anyone has listened to the other investor series that we've spoken about, intermediate and beginner, you'll notice that I finished the podcast. Write in. Let us know what you...
Let us know who's got the stronger finish.
What you think?
Got a couple of blokes writing in for you, I think. Ladies and gentlemen, thank you for tuning in. Big Paulie K, big Lukey Teeuwsen. Thank you, boys, for making the trip.
Thank you, everyone.
Jimmy, don't worry about it next time. All right? Guys, thank you very much. Jimmy, as always, mate, thank you for jumping in, joining, and being the center of laughs as usual. Laughing at you. Listeners, I hope you enjoyed the episode. If you did, if you took any great value, if you know any investors out there either aspiring to build a 10-plus property portfolio or potentially they already have a 10-plus property portfolio, please send this episode on. We would greatly appreciate it if you help us build the brand, build the community of people who think, talk, and act the same way that we do from a property investing perspective. If you love the episode, also make sure if you haven't left us a 5-star review yet, make sure you jump on there. You leave us a 5-star review. If you're not following us on the socials yet, Mr. Paulie K, where do they find us?
That would be on all the socials, on Instagram, Facebook, at APS.
Property Scout. Oh, I got him on the. I put him on the spot. He was already halfway out the door.
You can tell I'm on the socials.
At Australian Property
He's
Scout.
still on
guys.
MySpace.
Mate, you're on no
backing
space. Over at Australian Property Scout, guys, for all recent deals, clips, updates, everything that we've got going on, make sure you go over there and you check us out. And as a final note, guys, if you haven't hit the subscribe button, but you're loving the shows, you're loving the episode, hit the subscribe button. Make sure you send in if you're loving these episodes, if you want to hear more episodes like this, or whatever you want to hear. Make sure you're writing in, you're letting us know. Jimmy and I have got a Q&A coming up, guys, very soon. Make sure you're sending in the questions for the Q&A as well. Otherwise, guys, thank you very much once again for tuning in for another Scouting Australia podcast.